Listen, I think, Kelly, as Damon Runyon said, the race doesn't always go to the swift nor the battle to the strong, but that's the way to bet. And from our perspective, you have to play the odds. And the odds, I would argue, favor a recession later this year. And that's because the Fed's tightened as aggressively as they have. And also now with the banking crisis that we have, or the banking problems, if you will, whatever your odds of recession were a month ago, that one would have to think they're higher now. And as you pointed out, back to 1930s, earnings fall about 30% on average during a recession. The median is about 20%. We have them down 10% for this year. And I do think I want to see particularly some of the consumer companies and some of the, I would say, some of the mid-tier banks. I want to see them report to have a better idea. And the earnings are one thing, and I think the guidance is quite another, especially since some of these issues really came in the tail end of the first quarter. So I don't want to laugh it away. The market's up, and our view is a little bit on the defensive. But I still think if I'm playing the odds, I want to be cautious here.
Yeah, David, I mean, I don't know if I would say you have the same view or a similar view, but I was struck that you say, look, the Fed should pause. The more hikes they do now, the more cuts they could end up doing before the end of the year. Is that right?
Well, I'm one who believes that the Fed has been exacerbating a boom-bust cycle for my entire adult life, and that's exactly what I think will happen here. I think if they over-tighten, it will just simply mean that they are over-easy later, and I'm really tired of that cycle. I think it's very unhelpful. I think it mostly makes people more asset-rich and is really very bad for our society at large. But that is what I think they'll do. I think they'll end up over-tightening. They won't be satisfied until they break something. There's no possible way they can actually believe that people losing jobs is a good thing and a necessary thing to deal with inflationary problems that at this point are clearly rapidly disinflating. So for them to over-tighten, I just think means that they're going to end up cutting rates, and eventually we'll be heading back towards zero bound if it were to get bad enough. That entire cycle of non-moderate monetary policy is completely unhealthy.
No, I think that's well said, Jason. We talk a lot here about how they don't rely enough on leading indicators, on forward-looking sort of data points from the market. It's all just kind of rearview mirror. And Jason, one of the things that I hear so much lately is people who are dismissive of the recession talk because they say, oh, this is the most telegraphed recession we've ever had. Well, so then we should do something about it. We should try to stop it from happening, right? Yeah. I mean, that just means we've had months and months and quarters of sitting here waiting for it and saying, well, the Fed's going to keep hiking. And yeah, I wish that they would be more proactive in saying, yeah, we're a little scared when we look at the yield curve, too. Yeah, we see ISM. Yeah, we see the leading indicators. Yeah, we're worried about credit, and not just going, well, unemployment and inflation, and we're just going to, we'll just see where we are.
Yeah, no, it's a great point. And the Fed is very model driven. I believe it has about 25,000 employees, 1,000 PhDs. So probably, nothing good happens when you got 1,000 PhDs around looking at these things. And from my understanding, their main focus is the Phillips curve, which is just a fancy way of saying they look a lot at the labor markets, and for them, that is the leading cause of inflation. And so without any sort of meaningful weakness in the labor markets, it's hard to expect them to ease very much, or at least slow down. And in our shop, our chief economist, John Rissmuller, is of the view, for whatever it's worth, that the Fed should pause. And especially given some of the developments in the banking system, and just give it some time to see, because the lags in monetary policy are so long and they're so variable, we really don't know what the impact of the Fed tightening that started a year ago is yet.
Right.
So, we have a long way to go to figure out what's been done already. And it wouldn't be the worst thing. There are other issues that are coming into play. We're going into an election year next year. The Fed's credibility, I think, as David highlighted, I think is very much in question. And so there are other concerns here. But I don't know if it would hurt anyone if they paused and waited to see a little bit longer what the impact of their policies have been thus far.